Okay, let's get started. Okay, the people at the back can hear me? Okay, so good evening. Welcome to QF5212, Introduction to QF. All right, so this course will be taught by me and Prof. Julian. So I'll teach for the first 6 weeks. Then after that, you have 1 week of recess, and then Prof. Julian will take over from there. So this is roughly the schedule of this course. So for the first half, basically we have some foundation about stochastic calculus, the Edel's integral and formula, and a little bit of the Black-Scholes equation. Okay, then after Julian take over, you'll learn some change of numerators, and then optimum stopping time, variation options. All right. Okay, so in total there will be 13 weeks semester. Any questions? Okay. So at the end, your final grade will have 3 components. The first one is home assignments. There will be a total of 3 sets of home assignments that are due in week 6, week 9, and week 13. Okay? You'll get your assignment 1 week before the submission date, and then you can form a group consisting of up to 3 students. Okay? So if you want to do it on your own, it's okay, but you can form a group. And then later we will create the groups in Canvas, right? And then when we distribute the first set of assignments, there will be detailed instructions like how you can put, for example, 3 of you in the same group in Canvas. Okay? Pay attention to the deadline. Okay, it's Friday 6 p.m. because this time will be configured in Canvas. So any submission after 6 p.m. will be recorded by Canvas. Okay? So I encourage you not to submit by the last minute. Okay? Try to submit slightly earlier. And just a quick reminder, before you submit your assignment, do open the file and check it. Okay? So every time I receive assignments, I receive the original questions. Okay? And then there will be 2 in-class quizzes, 10% each. So you will be in week 5 and 10. Okay? It will roughly be about 20 to 30 minutes. It won't be a long, like an exam. And the question will be MCQ, multi-choice questions. Means you only need to choose A, B, C, or D. Okay, you don't need to write the details like how you get work done, no steps. Okay, so that's the format of the quizzes. And then final exam, 50%. So that's the big part. Okay. So in the final exam, the questions will be like, you need to write down the steps, how do you prove it, right? Okay. Whether there will be MCQ, it depends. I need to discuss with Julian on this. So it's not confirmed yet. We will give you more information in due course. There will be no midterm for this course. Okay, so you can enjoy your recess week. The final exam is closed book, but you can bring 1 A4 sheet, double-sided, and write down whatever you want. So basically, you get a 1 A4 size white paper and write down whatever you want. Okay? It's called a help sheet. No tutorials, so only lectures. There will be some examples or exercise uploaded in Canvas after each lecture. Okay? So it helps you to better understand concepts and prepare for the exam. Okay? Questions? Okay, feel free to ask any questions. Okay, Canvas. So Canvas is the system we use in NUS. Okay? Basically, all course materials will be uploaded to Canvas. This includes the slides, later your assignments, okay, solutions, okay. So typically, I'll upload the slides a few days earlier before the lecture, or maybe one day. So, and then in Canvas, there will be recordings for every lecture. Okay. Then there will be discussion function in Canvas as well, which is like a blog. You can post your questions, and then your classmates can discuss the same issue. Okay. These are some reference books, okay, like arbitrage theory in continuous time, stochastic calculus, okay. So it's for reference. If you have certain concepts which you feel like you don't really get the prerequisites, then you can find a relevant book. Okay, what you will learn in this course. Okay, so the key question we answer through this course is how do you price a financial product? Okay, what's the mathematical model you use to price a financial products? So to answer the question, we will learn some mathematical tools, okay, quadratic variation, Edo's lemma, Edo's integral, and stochastic differential equation. Okay. These are what we're going to learn in this course. And then later, in the second half of the course, you also learn how to apply these concepts when you're really trying to price a derivative of financial instruments. Okay. So some important concepts. The first one is called no arbitrage. So this is the very central and key concept in the modeling of financial derivatives. Okay, there is no arbitrage. So later in this week, we'll see like what is no arbitrage. And then pricing via replication, right? Which means for a derivative that you have no idea how to price it, if you can find something else that gives you exactly the same payout, then they should have exactly the same price today. Okay? And then the third one is pricing with PDE and stochastic differential equation, SDE. Okay? And then we will learn to apply these concepts to price options. Okay? The focus in this course is options, like call and put option. So these are called vanilla options. Okay, vanilla options. And then these are called exotics. These are exotic options, which are more difficult to price. Okay, so that's basically the introduction. Any questions so far? Okay, if no question, just a little bit of admin stuff. So I got requests saying whether they can switch between this class and the one at Friday afternoon. The answer basically is you cannot officially change. Okay, which means if you send a request to the department, they will reject. But say if you really cannot make it for your lecture, feel free to attend the other one. Okay? And just note, when there is a quiz and you want to switch, you need to let me know in advance, okay? All right? And then because the other class on Friday is, the size is much smaller. I think they have about 40, 50 students. So they don't have a lecture theater, it's more like a classroom. So they won't fit in a lot of extra students, okay? But if you really cannot make it for a lecture, just feel free to attend the other one. And if you really cannot attend both, then there will always be recordings in Canvas. Okay? All right. No questions, right? Okay. So today we will first have a little bit of history. Okay? Because this course is called Introduction to QF. So we will learn a little bit of history of quantitative finance. And then very basic, what are options? Okay? What are financial derivatives? And then we touch a little bit of the most basic model. It's called the binomial model. So today's lecture is not heavy. Okay, let's see. So the history starts, or the recorded history starts from Lewis. So he's considered a founding father of quantitative finance or mathematical finance. So in 1900, he defended his doctor. He got his doctorate degree through this thesis. So this is French. I think this one is theory. Okay, so you can use your Google Translate to see what it means. This is theory. This is speculation. Okay. So he used tools of stochastic analysis to evaluate financial derivatives. And then, like many PhD students, right, once they graduate, their thesis were forgotten, okay? All right? So that's why I say this is the recorded history, because we don't know whether there are any other research done on this, but never been found. Okay? But luckily for Lewis, his work was found by Jimmy, okay, in the 50s. So Jimmy discovered this work and then sent postcards to his friends in the economics. So among them, there's one professor named Powell. Powell. So he popularized the concept of modeling stock price as stochastic process. Okay, so that's rough. So the real work roughly starts from the 50s. So Powell discovered this is another Powell, okay, with other mathematicians. So they introduce a lot of properties of Brownian motion. So we will learn in lecture 2 or lecture 3 to learn about Brownian motion. Okay? So it's the first form of the stochastic differential equation. So they introduced the first set of SDEs. Okay? So this is also the key part of this course. Okay, now it's the famous guy Ito. So Ito systemized the study of SDE, okay? So he got a famous treaty published in 1948, okay? Which is called Ito's stochastic calculus. So you will learn Ito's integral, Ito's lemma, okay? So this is the fundamentals of quantitative finance. Okay, so these two are even famous, Black and Scholes. Okay, Black and Scholes, they published the article, The Pricing of Options. Sorry. The Pricing of Options and Corporate Liabilities. Okay. in which they introduced the Black-Scholes model. And it is used till today. Okay. And so in the article they write, if options are correctly priced in the market, it should not be possible to make short profits by creating portfolios of long and short positions in options and the underlying stock. So using this principle, a theory of valuation formula for options is derived. Okay, so Black-Scholes model is the very fundamental of the quantitative finance. And then together with Morton, so the model was enhanced or complete, is or called Black-Scholes-Morton model. Okay, so they won Nobel Prize. And then Morton and Scholes, they co-founded a very, very famous company called LTCM, Long-Term Capital Management. So if you have learned anything about risk management, you most likely heard of this company. A very typical failure in risk management. Okay, but we won't go in details of about this long-term capital management. Okay, so in the first 3 years, they returned very high return. So if you look at 20, 40, 40%, looks not so high, but it's they invest in fixed income, basically bonds. Okay, so in that case, these are considered pretty high returns. And this, until they are not so high any longer, right? So they collapse. Okay. So we won't go into details of this failure. Okay, so okay, so that's basically the history of quantitative finance. All right. So what is financial derivative? A derivative is a contract. Okay, it's a contract that derives its value. Okay, derive its value. So in this course, when we talk about the value of derivative, we call it phi. Okay, from the performance of another asset. This another asset, we typically call it S. Okay, so this another asset, we call it underlying. Okay, this is called underlying. So a derivative is a contract that derives its value from the performance of another asset. The most common derivative is called options. Okay. So when you buy an option, you pay a small premium. Okay? You pay and you buy, right? When you buy something, you pay a fee. So you pay a small premium today, and then with this option in hand, in the future, you have a choice. Okay? You have a choice. An example is if I buy an option on oil, then it gives me the choice to, in 1 year's time, the right to buy the oil at $61. Okay? So options give you the right, not obligations. Okay? So options give you the right, not obligations. Sorry. Okay, which means in 1 year's time, if you want, you can buy a barrel of this oil at $61. If you don't want, then you can just walk away. Okay? All right. So during the lecture, if you have any questions, just raise your hand. Okay, what is the role of financial derivatives? When do we use financial derivatives? Number one, we use financial derivatives for risk management purpose. Okay, so for example, airlines, their profit and loss are sensitive to oil costs or fuel costs. Okay, but they cannot wait until they buy the oil and then start to sell the tickets. They will sell the air tickets in advance. And they want to make sure when I sell the air tickets, I already know my cost, which includes the fuel. That's why that's when they want to use financial derivatives to hedge the risk. Okay? And then financial derivatives help you to get operational advantages. Okay? So because typically financial derivatives gives you lower transaction costs. Okay? Lower transaction cost. This is called T cost. Right? If you trade stocks, you need to pay tax, you need to pay commission, you need to pay processing fee, okay? And you need to pay twice when you buy and you sell, right? And then derivatives have better liquidities, right? When you trade exchange-traded financial derivatives, there will always be market makers, right? So you go to a investment bank, you ask for a quotation, they'll give you a quotation, right? How much they are willing to trade with you. And then derivatives require smaller amount of capital. Remember options, you pay a small premium today, right? So you do not, like compared to you buy a stock, you need to pay the full price. Or maybe you buy on leverage, at least you pay 20-30% of the spot price, right? Which is still considered high as compared to the derivative. Lastly is about speculation. Okay? Speculator is common in market. You trade and rely on your P&L. Okay, you want to make a profit. Okay? These are the common usage of financial derivatives. Okay, any asset can be the underlying of an option. Remember what is the underlying? Right? So a financial derivative is a contract whose value depends on another asset, which is called underlying. Right? So any asset can be underlying. An option is a derivative. Okay? Like for example, stocks. Okay? So stocks, bonds, currencies, oil, electricity, soybeans, indices. And now today we also have cryptos. Carbon credit. Okay, these can be underlyings. Okay, so stocks. In the market, stocks we typically call it equity. Okay, we call it equity. We don't really call it stock. Okay, for example, PE, right? Private equity. So we call it equity. So equity is one asset class. Bond is called fixed income. Okay, currencies is called FX. Oil, electricity, soybeans, these are called commodity. So these are the common asset class. So bonds sometimes is also credit. So derivatives are settled in future. You buy the derivative today, and you will settle it in the future, which is called maturity. Okay? You settle it at maturity. And then how much you're going to settle at maturity is unknown today. Okay? Unknown today. Usually unknown today. Okay? Means there are exceptions. Okay? There are exceptions. Let me give you an example where derivatives that you know exactly how much you're going to settle. Okay? Let me give you an example of carbon credit. Okay, this one. Okay, so the carbon credit, the most liquid carbon credit in the market is called EUA, European allowance. Okay, so if you go to the market, you look at its future price, say 1 month, 2 months, 6 months, 1 year. The price is simply like that. Okay. This is called futures. Okay. So for example, this is $60 or 60 euro. This is 100 euro, for example. So if I buy the 1 year future, which means in 1 year's time, you have to buy the carbon credit for $100. You pay $100, you get 1 ton of carbon credit. Okay, so there is a derivative in the market, which you pay $60 today. You pay $60 per day, and it gives you maybe not 100. Okay. Sorry. You'll get $95 back. Okay? How it is done? Okay? So this is a derivative. Okay? Within this derivative is actually you pay $60, right? To the seller. The seller will use these $6 to go to the market and buy a spot. Right? And then they will sell 1 year futures. They will sell 1 year futures. Okay? And then 1 year later, okay, after 1 year, because they sell these futures in 1 year's time, they need to deliver 1 ton of credit, which has been bought here, right? And then by selling that $60, by delivering the carbon credit, you will receive 100, right? But whoever selling this to you, they will charge a fee. So most likely you will get something like 95. So this is an example where you know exactly how much you're going to get at maturity. Okay? And for derivatives, today's price is known. Right? Today's price is known. So otherwise, when you buy it, there will be quotation given to you, right? So you know how much you're going to pay for it. So some pictures of CBOT and CME, and now the two has been merged. Okay, both are in Chicago. So on the very right is the trading floor. I think maybe 20, 30 years ago. Now we don't have a trading floor like this, right? Everything goes digital. Nobody gonna wave a ticket and shout how much you're gonna buy, right? Okay. All right. Okay. So this graph shows how the derivative market grew since year 2000. Okay. So before year 2000, the market is below $100 trillion. That's the volume. And then until about 2014, or before, or roughly 2008, before the financial crisis, it reaches about 600, about 700 trillion. Okay? And then when you have a market growing so fast, you know there will be a lot of hidden problems. And that's why the global financial crisis. All right. Then the question remains, how do we price an option? Okay, let's first look at the definition of arbitrage. So remember when we talk about what we learned in this course, one key idea is called no arbitrage. Okay, so arbitrage is a transaction that guarantees profit without any risk. You don't take any risk, sit there, you'll get a return. Right, that's an arbitrage. Right, I sit there, 1 year's time I got $2. If there is such an arbitrage opportunity, I will just buy 1,000, million, trillion times this strategy, right? No matter how small it is, I can just multiply it. Okay? Let's look at an example. This example is in the famous John House book. You all know this book, John House book. It's called Options, Futures, and Other Derivatives. It's QF book 101. Okay. So suppose a stock is traded on both New York Stock Exchange and London Stock Exchange. Okay, it's traded in both markets. The stock price is $200 in New York and 100 pounds in London. The exchange rate is 2.02, which means 1 pound is equals to $2.03. Okay? Okay, now, if we buy 100 shares in New York and sell them immediately in London, let's see, okay? So when we buy these 100 shares in New York, we pay for each share, we pay $200, okay? We buy 100 shares. This is how much we pay. Now, how much we're gonna get? For this is dollar, right? This is dollar, and this is pound. And we sell them in London. We still have, for each we get 100 pounds, okay? And we have 100 share. and we want to convert the pounds into dollar. Okay, 1 pound is $2.03. So if this one we times 2.03, then we convert the pounds into dollar. Right? So the difference is $300, which means by doing so, without taking any risk, you earn $300. That's when you buy 100 shares, and then you can buy 1,000 shares, 10,000 shares, right? And this is called an arbitrage. Okay. And when we model financial derivatives, we assume there will always be no arbitrage. Okay? We always assume no arbitrage. Means no profit can be made without taking a risk. If you eventually make a profit, which means you take some risk. Okay? Whatever risk it is, you take some risk. Okay? No free lunch. The reason why we have such a no arbitrage assumption is we assume when there is an arbitrage opportunity in the market, someone will come in immediately to take this arbitrage. And when someone comes in to take this arbitrage, the market will react, okay, by supply and demand, and very quickly the arbitrage will be gone. Okay? All right. Okay, let's see some common fundamental financial derivatives. Okay, so the first one is called forward. A forward is a contract, okay, where two parties, A and B, two parties, agree to buy an asset, agree to buy or sell an asset at a future date T, maturity date, okay, and maturity date T, at the predetermined price F0, okay, this F0 is the forward price. Okay, at a forward price. Okay, so as compared to option, forward is you agree to buy or sell. There's no right. Both have the obligation. So one party has the obligation to buy or sell the assets, and the other party has obligation to sell or buy. Okay? So for a forward contract at the inception day, there's no exchange of money. No one pays anything. Okay? So if anyone has to pay anything, it will all be hidden in the forward price. Okay? So the forward price will be adjusted to reflect the fee. Okay? So at maturity, okay? Suppose at the maturity, the underlying asset price is ST, capital T, okay? Which is unknown at inception, T0, or any T. Okay? So this ST is unknown from inception until for any time before maturity. And then at maturity, when the buyer pays the forward price, which is F0, right? The buyer pays the forward price and will receive the underlying asset. And the underlying asset worth ST at time T. Okay, you hold this asset. So basically, the value of this asset to you is its market price. Right? if you trade stock, suppose you have one share of Apple. What is the value of your portfolio today? It's basically Apple's market price, right? So the value of this asset in your hand is its market price. Okay, that's why the S capital T. Okay, then the question is, how do we set this F0? How do we set this F0, the forward price? Right, which must be fair to both parties, A and B. So assume the share price today is $100. Okay, and suppose you are the buyer of this forward contract, and you perceive that the price will go up to $130 in 1 year's time. What should be your forward price? What if you perceive that the share price is going to collapse to $60? What's the difference? Are you going to have a different forward price? Okay, let's see. Okay, let R be the continuous compounded interest rate. Who knows where is continuous compounded interest rate? Who doesn't? So you know what it is continuous compounded interest rate or not? So, okay, everybody must raise your hand, okay? Who knows? Okay, who doesn't? Okay, let's just quickly have a introduction about what is called continuous compounded interest rate, okay? Suppose you go to a bank, okay? You go to a bank, you do a fixed deposit or time deposit of 1 year's time, and the interest rate is 2%, okay? So basically, you put in, say, $100, and then it's 2%. And maturity, how much you get? You get 100 times 1 plus 2%, right? You got $102. Okay, this is called annual compounding. This is called annual compounding. Okay, then what if the bank will pay you the interest every 6 months? Which means it gives you 1% and then give you another %. So after 6 months, you will get you get 1% or $1 after 6 months, right? And then you get another 1%, not on the $100, but on the $101. Okay? So this is semi-annual. This is called semi-annual compounding. Okay? And then if you compound 4 times, right? You compound 4 times. Quarterly compounding. 12 times, monthly compounding. 365 times, daily compounding. So, suppose N is your deposits. Okay, in the example, it's $100. R is your interest rate. Okay? Okay, so let's forget about the notion of S. And then you take the limit into the power. Then you get continuously compounded. That's what I mean by continuously compounded. Okay. Okay. Now, if R is if R is your continuous compounded interest rate, okay, you put in N dollars. After T time, you will get N RT. Okay? So continuous compounded interest rate is nothing but how you accumulate your interest. Okay? How you calculate your interest. So you put in some capital N. After time T, you will get N times e to the power of RT. All right? Okay. So this is a little bit of interest rates. Okay. In the market, this R is typically called zero rate. This R is called zero rate in the market. But for this course, you just know it's interest rate. Okay. Okay. Now let's see. Let's get back to the forward contracts. Let's consider two strategies: strategy A and strategy B. Okay. Let's look at A first. At T0 today, I buy the forward contracts. Okay. So because today I didn't pay anything, my value is 0. Right? And then at maturity, I'm obligated to buy the share and pay the forward price. So I pay the forward price, which is negative F0. Then I buy the share, which was ST. Okay? So this is strategy 0. This is strategy A. Okay? Okay. Let's look at strategy B. For strategy B, I borrow S0 from the bank. Okay? So I borrow some money from the bank, which is S0, which is just enough to buy one share in the market. Right? So for strategy B at T0, S0 minus S0, which is 0. The reason why I write 2S0 because the first one is a loan. Okay? And the second one is a stock. Okay? And then at maturity, for strategy B, I pay back the interest. Okay? Remember what the interest, you borrow S0. So at maturity, your S0, when you return the money to the bank, you need to also pay the interest. It becomes S0 times e to the power RT. Okay? And then you're still holding this stock. Either you sell in the market or you still hold it. Its value is S capital T. Okay. So if you look at strategy A and the strategy B, you have the same initial cost, right? Which means you pay the same amount of money or receive the same amount of money at inception. So by no arbitrage, at maturity, you should get exactly the same amount. Then how much do you get in strategy B? S capital T minus the value of the loan. So which means in this case, your F0 should be S0. Right? So these two components should be equal. Okay. We need some further assumptions actually. For example, we need to assume there's no dividends. Right? We assume the stock has no dividends. So then you're at time 0 and at maturity, you should have exactly the same payoff by no arbitrage opportunity. Okay? If not, if these two does not equal, you will have an arbitrage opportunity, right? And if you look at this, your forward price is simply your spot price plus interest rate, and has nothing to do how you perceive the market want to move. Whether you think the stock price will go up or you think stock price will go down, the forward price has nothing to do with this probability, okay? So it's irrelevant. Okay? Okay, questions? No? Okay, let's consider two different stocks with the same initial price. Okay? For example, Amazon and Deutsche Bank. So if you think Amazon's price will go up and Deutsche Bank's price will go down, but in a forward contract with the same initial price, with the same interest rate, you should expect the same forward price. Okay? And this forward price has nothing to do with your expectation of the future price of the stock. Okay? So this should be your key takeaways from this. Okay? Okay. Okay, so this is the forward curve. Sorry, this is the payoff curve of a forward contract. Okay, which means at maturity, if your underlying price, which is S capital T, this is underlying price at maturity, if it is exactly the same as your forward price, then you get zero payoff. And if the price is above the forward price, then you have make a gain. Okay? And this gain is S capital T minus F0. However, if your forward price is lower than your forward price, you'll get a loss. Right? Because on this side, your ST is smaller than F0. Okay? And this type of payoff in the market is called linear payoff. This is called a linear payoff. It's very intuitive, right? You look at the payoff chart. It's a line, so it's linear. Okay? So this is called a linear payoff. Okay, now options. Okay, just now we say options are gives the buyer the right but not obligations to buy or sell an underlying asset. So let's see the detailed definition, right? So here when we talk about option, we talk about European options. Okay? Later you will see other options, American options, barrier options, Asian options, basket options, okay? Touch options. But for now, we look at the most basic vanilla option, the European option. Okay? The European option. And then now we talk about call option. Okay? So a European call option is a contract that gives the holder, the buyer, okay? The holder or the buyer, the right, but not the obligation to buy from the seller or issuer. Okay? An agreed financial instrument, okay? Which is S, okay? To buy S. And at a given time in the future, which is called maturity, okay? Maturity. For a given price that is fixed today, that is called strike, typically read as K. So an option, if you hold an option, then you have the right to buy the underlying asset from the seller at maturity. But if you decided not to, you can walk away. And if you decided to buy, and that is called exercise. Okay? So if you decided to buy from the seller of the option, it says you exercise the option. Okay? So these are the key components of an option. The first one is strike, K, which is how much you need to pay or receive when you exercise the option. And the second one is called maturity date, okay, denoted by capital T. That is when is the end of the contract. Okay? So if at maturity, suppose you are the buyer of this option, right? So at maturity, you have the right to buy. But if the underlying asset price is lower than the strike, you are not willing to buy, right? You don't want to buy it, right? Suppose the underlying is Apple share price, and the market price is 100, and then the strike price is $200. Are you willing to pay $200 to buy a share that was $100? No. So when your underlying price is smaller than your strike, you will not exercise the option. You will just walk away. And what you get? 0. Okay? However, if it's the other way around, right? The market price is $200, the strike is $100. You're willing to pay $100 to get one share of stock that you can sell for $200, right? So in this case, you will pay the strike and receive the underlying. This is your payoff. Okay? So the payoff on the option, which we write as phi st 0 if st smaller than k, and st minus k if your st is greater or equals to k. Okay? The equal sign you can write either way, right? Because when st equals to k, whether you exercise or not the option, you still get 0. Okay? And this is written as st minus k. We write a bracket, or put a plus. This means the max of st minus k. This is by definition. Okay? So all right. So we define the maximum of these two numbers, and we write it as put in a bracket and write a plus. All right. So what is an European option? So an European option, you can only exercise at maturity, capital T. So you can only decide whether to exercise your option or not at maturity. That's called European option. And then on the other side, you have American option, which you can exercise the option at any time. At any time t, between the time you sign the contract until maturity, right? So as mentioned, there are many other type of options, right? You will see a few towards the end of this course. So what's the fundamental difference when we use forward or options for hedging purpose? Okay. So for forward, we neutralize risk. If you buy a forward, basically you take no market risk. You take no market risk, right? If you look at back this, right, the two strategy will always give you 0, right? So it basically we eliminate the risk by using forward to hedge our risk. But for options, right? For options, if the market goes the way against your view, if you hedge with an option, the option will compensate you, right? Will compensate you, and then to hedge away your risk. However, if the market goes along with you, right? Which means you make a profit from your underlying, then you can just walk away from the option and it still make a gain. Okay? Right? So from the payoff perspective, it sounds like options is much better than forward. But remember, for forward, you pay nothing at the beginning. Okay? But for options, you need to pay a fee. Okay? So the cost of option is higher, but it allows you to benefit from favorable price. Okay? So for option, when the underlying price is greater than the strike, for call option, that means if this ST, S small t, becomes ST, then you make a profit, right? If this price does not change until maturity, then you make a profit, and this is called in the money. Okay? If you see this short form, ITM, it means in the money. Or if your option is below the strike, right, which means you get 0 until maturity if price does not change, this is called out of money. And if they are exactly the same, it's called ATM, at the money. Okay? And if you look at this payoff chart, you see, when the stock price or underlying price is below strike, you get 0, right? Until it crosses the strike, you will always, this part is 0, this part is ST minus K. Right? So it's not one line, right? So this is called nonlinear payoff. So this payoff is nonlinear. Okay? Any questions so far? So the put option is the opposite of call option. Okay? So a call option, if you buy a call option at maturity, you have the right to buy the underlying asset. So when you buy a put option at maturity, you have the right to sell the underlying asset. Okay? But still, you don't have any obligation. As long as you buy an option, you have no obligation. But you have the right. For put option, you have the right to sell. Okay? So as compared to call option, the difference is at the payoff. Right? So in this time, if the strike price is is the underlying price at maturity is greater than your strike, then you get 0. If ST minus K, greater than K. Otherwise, you got K minus ST, right? If ST is smaller than K. Okay? So we can also write the payoff in the form of this, in this convention. Put a bracket, put a plus. Okay. So this is the maximum of 0, k minus st. All right. So this is a payoff chart of the put option. So we still have the definition of in the money, out of the money, at the money. How do you tell it? You just look at the payoff, right? Remember for put option, the payoff is k minus st, right? So you just put it in this way. If you substitute by a small t, if this one is positive, then it's in the money. It's negative, then it's out of the money. Okay? It's the same for call options. So you can just write this one as phi. Okay? So for a put option, if you own a put option, you make money when the underlying price goes down. Okay? When the underlying price goes down, you make money. For the call option, you make money when the underlying price goes up. Okay? Okay, let's look at the financial markets. Okay, after we get know about options. In this course, when we consider the financial markets, we typically consider 3 assets. The first one is called money market account. So what is a money market account? Basically, it's your deposit account or it's your loan. It's an account where you can put your money, you can deposit your money, you can borrow money out. And we typically assume, at least within this course, we assume the interest rate for your deposits or for your loan is the same. Okay? So basically, the money market account will put your money in the bank, invest in bonds, or whatever. So you get an interest rate. This is the key. The interest rate is known, right? The interest rate is known. Suppose in the beginning you have B0, right? Suppose initially your money in the account is B0. It can be positive or negative. If it's a positive, it means you have a deposit. If it's negative, it means you borrow some money from the bank. And then, this is T0. At T, the value of this one will just become ERT. Okay? So this is your principal plus interest. Okay? So the key is that the value of this money market account is known today for any time in the future. Right? Today I put $100 in my account. How much money I'll get in 1 year's time, 2 years' time, 10 years' time, 100 years' time? I can do a calculation and know it. There's no uncertainty within this money market account. Okay? So the second type of assets, we call it the fundamental assets, or typically we call it the underlyings. Okay? The underlyings, for example, are stocks, commodities, indexes, FX, forex, exchange rate. Okay? This is called the fundamental assets. So for these assets, today's price is known. Okay? You own a share. How much it is today, you know. How much it is tomorrow, unknown. Okay? So the future value of the underlying assets is unknown. So because it's unknown, we need to model the behavior of these underlying assets. So typically we write the price of this unknown asset as ST, okay? For the price at time t, okay? Which is not known for any, so this ST is not known for any V smaller than t. Okay? Oh, sorry. Yes. So ST is not known for any V smaller than t. Okay? So the last one is the financial derivatives, okay? Whose value depends on the fundamental assets. Typically, right? Phi S. Okay? So phi is the value of this derivative, and it depends on the value of S. Okay? Any questions? Okay, maybe let's take a break and come back at 8:30. Okay, thank you. So if you buy, this is your payoff of a forward. Suppose what you want to hedge is another S. So this is your final payoff. This is your forward. This is what I want to hedge. Then this will give you a constant. Which means initially you only have this one. So which at t0 you do not know where it is value. So that is your uncertainty. If you use a forward contract to hedge this, then you know exactly at maturity how much you can get. So your risk associated with the underlying price is totally gone. Okay. So initially, without this one, you have initially a negative risk. Then it becomes there is a market risk, right? Because you do not know this one. But with this forward contract, you always get minus K. So there is no market risk, a constant. You know the price at the beginning. There's no market risk on the underlying. When your final payoff depends, it does not depend on the market. That's only risk neutral when it's a hedge, right? Yeah. That's why when we say use a forward to hedge, then you have risk neutral. I see. Yeah, phi is a function. Typically, we write phi. Later, we'll find something like this. So, from a functional space to a scalar space. From a functional space to a scalar space. What thing? So we left this one from continuous functions to R. No, it's just a one. It's just a function. It's just R to R. It's R to R.
Just out of curiosity, so since future contract depends on for interest rate changes. You can, right? Yeah. I mean, in a way, it's quite interesting because assets like gold, for example, if interest rate goes up, gold value tend to goes down. So that goes down, but the future value goes up. So it just, I mean, does that also occurs for arbitrage or something like that?
No, it's not. It's not.
It's not arbitrage.
It's not called.
I see. I see. But you can in theory do that.
You can do that, but it really depends on what you perceive. Right? You think the market will go up, but that may not be true. In the market, we only talk about volatility. Right? We don't say I think it will go up.
Yeah, that's
What you perceive.
something I can try. Thank you, Rob.
Okay, so for this course, we're assuming constant interest rate. But in the market, or maybe another course, we'll learn something called term structure. A term structure is a curve. It's a curve.
This is your T. This is your interest rate. Something like this.
So interest rates is a known function.
Yeah. So no, the interest rate today, you know, today your interest rate is not for any maturity. So if today I want to borrow 6,000 for 1 year, then you will give an interest rate, right? So within this 1 year, your interest will not change.
No. So why this curve is not positive, convex, or concave?
No, it can be anything.
Can be anything.
Yeah.
So if I want to use the right curve strategy.
So if you look at United States, the dollar maybe now is like this.
Oh, okay.
Regarding that question, I'm not sure why is it bureaucracy over extension costs spot markets? Why have
Okay, that's just how it works. Because in the derivative market, right, you don't need to have a lot of out-of-pocket money. That's why it's more favorable, and so that's why the high volume. The transaction cost is lower, like I said. It's just how do I say? It's a nature evolution.
so because they are contracts, so I don't have to pay for the full price to sign the contract. So that's why we can decide much cash. And regarding it's like if I'm pessimistic about Deutsche Bank, I think it would price will go down. So I think in this case, I will not. If I'm sure it will go down, so I will not sign.
Nobody can be sure for any stock moving either. Because the assumption is that the current price reflects all the information in the market. So tomorrow, how the price will change is all random, either up or down.
So if I assume that it's very likely.
No, that's your own perceive. Right? You perceive, you think it's going down, but there are other people who think that's when the transaction is. If you are sure it's going down, nobody's going to buy. Avoid.
So if I'm sure it's going down, so if I'm in my perception, I think it's very likely. It's like 19% will going down. So in this case, I won't buy a forward contract for
Yeah.
that.
You can sell one. Right? You can sell one.
So there's a similar to option rules have call forward.
No, just buy or sell. Forward is just buy or sell.
And like in this payoff function, so I remember that we have to sign a premium at the
You pay a small premium, I think. Yeah. So there are initial costs.
but it's not reflected.
This is the final payoff.
So the premium is that because the premium is very small compared?
Because for this course, we are trying to model the price of this. The premium is paid at zero, right? So for any time after zero, you care about follow the interval. It's not necessary to follow that clock.
And also like, so regarding the call option, like, so it's essentially I buy right to buy some commodities, like fixing income in the future in a certain price. So I can choose buy or not
Yeah.
at that time. But what about the seller? The opposite party opposite.
You want to buy, then you must sell.
Must sell. But
If
if
you
I
walk away, then you just pay a trade.
But for him, for me, it's like, yeah, for me, it's called a call option. But for him, what kind of,
Sell and call. Sell or call.
So there's a kind of obligation to sell, to have to sell the options.
Yeah, the seller has the obligation. If the buyer chooses to exercise the option, the seller must fulfill the contract.
it's different from zero forward because
Yeah, the forward is both parties must exercise it. Yeah, it's an agreement. 1 year's time, one pays the money, the other deliver the
I never like because like for the option. So I think there's zero risk.
what?
Zero risk.
Yeah. Okay, for the buyer, seems like in the market rates because now I own a call option which was $5. I buy for $2. Now it was $5. Do I have a risk? I have a risk. Tomorrow it will be $4. I still have a risk. But you say from the beginning to the end, the maximum loss from the beginning to the end is okay.
So the risk is very low.
No, because it is a kind of leverage. You must buy a large amount of the options to maximize your return. So
No, it basically means from the beginning to the end, your investor, right? It's like about $1, then your maximum loss in the market is $1. So this is the whole thing. The maximum loss is $1. The maximum gain is
So I understand it as a very low risk investment.
okay. So the risk, the concept of risk in the market is very different.
Well, for me, I'm sure I will lose at least $1. So it's, for me, it's very low risk. So
That
like,
is because you compare your maturity at the beginning. But you don't compare from yesterday.
and before the risk, I think it's much higher than that. So if the price of the commodity goes down very fast, so I may lose a lot. Right?
Okay, so in the market, forward delta one, close to one. That's it. For option, it is in the money, it's also close to one.
Similar risk.
The only position in the money, very in the money. At the money, it's about half.
What do you mean?
At the money, you just cover with at money.
no pill. Yeah.
At the
The
money.
exercise price is stock.
So for at the money, so you will learn that in risk management. There's a course, right? 520 something. US, what
I think that's all the exercise.
So I want to know that in practice, as a content, we just check the first part of the content. You said that we get the ito integral, ito formulas. That's it?
Ito's lemma, SDE.
Yeah, does this relate with our practice, the options pricing?
Okay, so basically the first half is supposed to give you the foundation. It tells you why and how to use it, and then you know how to use it in price.
So, 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 so
Black-Scholes is, okay, Black-Scholes is, this is called introduction. You need to build up from there, from Black-Scholes, maybe to local wall, stochastic wall, stochastic wall, to more complex models. But from the beginning, you understand Black-Scholes models, you can build up your.
But it uses
Stochastic.
stochastic process. So does it contain all of the probabilities of the future price of the function?
So basically, all the exotic models I know in the market are stochastic. They're all stochastic, but with different underlying assumptions. Right? Some holds your measure linear function, some has a mirror version. Right? The fundamental is stochastic.
So the BSM model is just some specialized example with
It's an oversimplified model.
Oversimplified
Basically,
model. Okay.
Black-Scholes model is an oversimplified.
So if I want to construct a more complex model, so I need to use the Ito integral.
Yeah, basically that's all the basic.
All the basic.
Yeah, those Ito's lemma are the basic. You want to build up on that, you must build up on that. Any other like can better.
Okay, let's continue. All right. How do we price an option? Okay, we have seen the call option and put option and understand its payoff. Okay, so basically at maturity, how you're going to settle the contract. So when you buy the option, the buyer need to pay the seller a premium. Okay. So this is called the premium, a certain price which is called the premium. Okay, and then at maturity you get a payoff. Okay, so for example, call option. Then how do we calculate the price of the contract at any time t before maturity? Okay, how do you price it before the maturity? Because if today is maturity, I know the price of my underlying stock, then I know the payoff. But one day ago or any time before that, you do not know the underlying price and maturity. So in that case, how do we price the contract? So the idea is, if we have another investment, in the money market account and the stock. Okay? If you can construct a portfolio, or basically you have some money in the bank account, buy a certain number of shares, and the combination gives you exactly the same payoff as the option, then you know the price of the option is the same as the price of this combination. Okay? So it's basically similar to what we have seen in the when we say how can we know the forward price of forward contract, right? So the value of an asset at any time t is the amount of dollars, okay, that you're going to pay. Okay? For example, underlying ST, right? Market price. You will pay ST to buy one share. Okay? So what is a position? Position is what you own. Okay? Position is what you own. So it's the quantity of an asset you own or you owned. Basically, you borrowed. Okay? You buy it or you borrowed. If you have a long position, you own the asset. If a short position, you borrow and sell. Okay? So if you trade stocks, you know there is something called short sell. Okay? You can borrow and sell in the market, which means you short sell. And later you buy back from the market and return, right? That's a short position. A portfolio. A portfolio is a combination of positions in different assets. Okay? You can construct a portfolio with 100 shares in Apple, 200 shares in Amazon, 300 shares in Tesla. Okay? So that's a portfolio with maybe another, you buy also the US Treasuries, some fixed deposits. Okay? So that's called a portfolio. Okay, in our case, we assume we have a very simple portfolio with only invest in money market account and the underlying stock. Only two assets in our portfolio. Okay? So the value of our portfolio today, suppose we have the portfolio is alpha in the money market and beta in the stock. Basically, we have alpha dollar in the money market account, and we own beta shares of the underlying asset. Then the portfolio we write is alpha and beta in R2. Okay? We can define this portfolio in a vector. And for any time t, for any time t, the value of the portfolio is alpha bt plus beta st. And we know bt, what is bt? bt is ERT, right? Actually, okay, sorry. Maybe we should write bt is b0 ERT, right? So if you assume b0 equals 1, then this is just ERT, okay? Why we assume b0 is 1? If it's not, then it becomes the alpha. Okay? If it's not, it becomes the alpha. See that? So if alpha bt, if it's b0 is not 1, it's 2, then you just change your alpha. Then your b0 becomes 1. Right? Okay, so your value is alpha bt plus beta st, and your bt is known. Okay, so we look at the simplest model in the financial mathematics, okay, which is the binomial model. Okay. In this model, the setup is that we only have two time points. Okay, at the beginning, when you buy the contract, that is 0, t0. Okay, t equals 0. The other one is at maturity, your capital T. You have only 2 points. Your money you can borrow money from the bank, or you can deposit your money in the bank. Both gives you the same interest rate, R. Okay. Okay, so that's your money market account. And then your price, underlying price, at the beginning, your underlying price at the beginning is known. Your underlying price at maturity, S capital T, is unknown. But we assume there are only two possible outcomes. Okay, only two possible outcomes. One is it will go up, the other is it will go down. Okay, so we assume the price will either go up or go down. And for each possibility, we assign a probability. Okay, if it's go up, we assume the probability is PU, and if it's go down, we assume the probability is PD. And because we assume there are only two possibilities, so we know PU plus PD equals to 1. Right? It must either go up or go down, because that's the assumption of the model. Okay? Okay? And if it's go up, we assume the price will go to the initial price times some multiplier U. And if it's go down, you go to another multiplier D. Okay? So this is the setup of the model. And then we will construct a portfolio. Okay? We will construct a portfolio. We call this portfolio H, which consists alpha position in the money market account and beta shares of the underlying assets. The value of the portfolio at any time t, this is already given in the previous slides, and we assume B0 is 1, right? Because if it's not, we can always multiply by the alpha, okay? Okay, so let VTH, okay? VTH be the value of the portfolio at time t, okay? These are some notation, just some notation. The value of the portfolio is V, okay? So the T, okay, represent the time. So this means the time, and this means the portfolio. And if it is positive, means I have some initial cash out. I need to pay some money to construct this portfolio, right? So that's why your initial value of the portfolio is positive. If your initial value of the portfolio is negative, which means you received some money to build the portfolio. Okay? Because it's negative, which means you need to return this back. Okay. Then alpha is the position in money market account. If it's positive, means you have some money in your deposit. Okay? If it's positive, means you have a deposit in the bank account. Otherwise, if it's negative, you take a loan from the bank. You borrow some money. All right? This is how you understand the positive and negative. What does it mean? Okay, the sign of these parameters. Okay, let's look at an example first. Suppose 1 barrel of oil today is $38. Okay, the price is $38 today. In 1 year's time, we assume the price will either go up to $28 with probability of 1/3, or, it will go down to $38 with probability of 1/3, or will go up to $68 with probability of 2/3. Okay. Suppose you want to, you are an airline which you are sensitive to oil price. I want to do a hedge. Right? You want to buy this option. Suppose, typically, if you look at the market, the most liquid option is called ATM option, okay? It's ATM option. We already introduced what is ATM, add the money. So basically your strike equals to your spot. So let's look at an option, ATM option, right? The strike is ATM, also $38. Mature in 1 year. And for simplicity here, we assume the interest rate is 0, no interest. So your money market account will stay constant. You got no interest. So how do you value this call option? So if the price goes to 68, the option gives the airline the right to buy at 38. And then the airline will make a $30 gain, profit. On the other side, if the price goes down, then the airline will not the airline will just walk away, right? Without exercising the option. And then the payoff of this option is simply 0. Okay? So this is how we write the payoff of a call option. Recall this one? Okay, let's see. Oh, first we ignore the storage cost, which means if you buy the oil today, it costs you nothing to put them somewhere. Okay, let's look at the strategy A. We buy the option at a price, which we do not know yet, and receive the unknown payoff of the option, right? You receive this option, but it's unknown. And then we want to build another strategy B that gives us exactly the same payoff as strategy A. Okay, let's consider this strategy B as a portfolio consists of alpha dollars in the money market account and beta shares, oh sorry, it's not shares, beta units of the oil. Okay? So we want to choose the alpha and the beta such that no matter the oil price goes up or down, the two portfolios, or two strategies gives me exactly the same payoff. Okay? So if the oil price goes up, my money market account is fixed, right? But I assume the interest rate is 0, right? If I assume interest rate is 0, ERT is just 1. And then for each underlying asset, the price is 68. And my strategy has beta unit, right? So this is my payoff of my strategy B when the underlying price goes up. And on the right is the payoff of my strategy A when the underlying price goes up. Okay? And if the price goes down, my money market account stays the same, but my assets becomes $28 1 unit. And my payoff from the option is 0, right? So I built a system of linear equations such that no matter the price goes up or down, my two strategies gives exactly the same payoff. And this system, linear equations, has unique solutions, right? If you try to solve it, your alpha will be -21, your beta is 3/4. Okay, so this system equation, you have two equations, two unknowns, alpha and beta, right? So the solution is unique. So what does it mean? You have -21 alpha means you're holding a negative amount. You're borrowing from money. You borrow $21 from the bank. Okay? You borrow $21 from the bank. And then that three-quarter means you buy three-quarter of the underlying assets. Okay? So you borrow some money, use the money to borrow some, to buy some underlying assets. So today, the value of your portfolio is that 21 is the money you borrowed. And that three-quarter is the amount of underlying assets you buy. And then $38 is the price today. So you add up together is the value of your portfolio today, or the value of your strategy B today. And since your strategy A and strategy B gives exactly the same payoff at maturity, they should have exactly the same value today. So that gives you the value of the call option, 7.5. Okay? So this is we replicate the option by another portfolio. Okay? So if the price of the call option is greater than 7.5, then what can I do? I can sell the option, right? The option is overpriced. Then I sell the more expensive one, the option. Then I'll buy a portfolio which consists of that 21 3/4, right? I buy a portfolio. Then I would be able to make money at no risk. And similarly, if the option is underpriced, below 7.5, then I'll buy an option and sell that portfolio, that strategy B. I will be also to make money with no risk. It means any price other than 7.5 is an arbitrage opportunity. Okay? Okay. Remember, we assume the price will go up. Sorry. Okay. The price will go up with probability of 2/3, and the price will go down with probability 1/3. But when we calculate this 7.5, you do not see these 2/3 and 1/3 probabilities here, which means they are irrelevant in the price of the call option. Okay? So if you're first time new to quantitative finance, this may be a little bit counterintuitive. Okay? It has nothing to do with probabilities, right? So, which means if you have two stocks, today traded at same price, right? And then you think later one goes up, they will go up. There are two probabilities, right? Two probabilities. One will go up, one will go down, and then the price that go up will go up to the same. Go down will go down to the same. But the probabilities are different. But when you price the option, you see the probability does not matter, which means they will have exactly the same option price. Okay? Right. So you see the probabilities do not matter. Okay, there are some hidden assumptions we have made. Okay? First one, you can make long and short positions. If you know that short sell, first of all, it may not be allowed by some markets. Second one, short sell are more expensive. But here we assume there's no extra cost if you short sell, okay? And there's no borrow cost if you short sell. We assume there's no transaction cost, right? And we assume the market is perfectly liquid, simply because if you really trade stocks, if you buy 100 shares, okay, the market does not move. You buy 1,000 shares, okay, the market does move. You buy 1 million shares, the price will shoot up, right? Now we assume no matter how much you buy or sell, the price remains the same, okay? It will not. It's like you buy or sell in the simulator, okay? And we assume there is no credit risk, right? Remember when I say if you use a forward contract to hedge your spot exposure, you will hedge out all the market risk, right? You hedge out all the market risk, but not credit risk. What is credit risk here? What does it mean? It means, first of all, you may have some money in your money market account. We do not consider a possibility that your bank go bankrupt, right? And then you may hold an option, and you also do not consider a possibility that whoever sells you the option goes bankrupt. Okay, so these are credit risk. We do not consider credit risk in the modeling of financial derivatives typically, unless it's credit related. For example, corporate bond, we consider. Also, this is not about option, just some other topic. When do we consider credit risk in pricing financial products? Typically when we price, like say corporate bond, credit default swap, okay, government bond in foreign currencies. That's when we directly model the credit risk. Otherwise, they are modeled through something called CVA. Okay. It's called credit valuation adjustment, which means, okay, first of all, let's do not forget about the credit risk. Let's price it. Once I get a price, let's adjust it for credit risk. Okay, so it's a credit valuation adjustment. So that's why let's forget about credit risk first. Okay, let's look at any questions so far? Any questions? No? Okay, then let's look at the second example. Okay. Suppose today's price of Microsoft shares is traded at $100. In 1 year's time, it can either go up to $150 or $95, both with 1/2 probabilities. We assume the zero interest rate or continuously compounded interest rate, R, is ln 1.1. Okay? And then the bank's client wants to buy 1 share, ATM call option. Okay, so ATM option strike is, since it's ATM option, strike is 100. Okay? So it's a call option. Your payoff is okay. This is your payoff. Okay, again, let's find a portfolio that replicates the payoff of this call option. Okay, the payoff is this call option. Okay, so my S0 equals to 100, it will go up to 150 with 0 probabilities. It will go down to 95 with the same probability. And then my payoff, if it goes up, my option payoff will be 150 minus 100. This gives me 50. Otherwise, it gives 0. Okay, now we want to do exactly the same as example 1. We construct a portfolio with some in the money market account, alpha in the money market account, and beta in the underlying equity. Okay? So someone may wonder what is 1.1, right? Remember your R is ln 1.1. So in 1 year's time, your alpha in the money market account will become alpha e to the power of RT. Your t equals to 1, right? So this becomes 1.1 alpha. Okay? So if it goes up, I got 1.1 alpha in the money market account, and my underlying equity goes to $150 per share. I got beta shares. And in this case, my portfolio gives me exactly the same payoff as the option, which is $50. And this time, again, you get a system of linear equations, two equations, two variables. You get a unique solution, alpha and beta. Okay? So the price of the option today is the price of your strategy or your portfolio today. Right? Your alpha is negative something, your beta is positive something. Okay? And then the value of the portfolio today, you just substitute alpha and beta, you get 12.4 roughly. That is your value of the option. And again, you notice that these two probabilities does not fit in. Okay? So the value of the option has nothing to do with probabilities or real-world probabilities. So today, the bank will sell the call option to the client, which we have already calculated the market price to be 12.4. Okay? Maybe slightly higher because the bank will charge a fee. And we borrow this alpha because it's negative. We borrow alpha from the bank. And we buy a fraction of the share, okay, 10 over 11. So we buy a fraction of the share. So this is the assumption, right? You cannot really buy this from the market, actually. But in mathematics, we assume we can. So we buy this amount of shares of underlying equity, which is approximately $90.9. So the total initial cost for the bank is 0. Right? The total initial bank is 0 because the bank sells an option and buys a portfolio that is exactly the same as the option. Whose payoff is exactly the same as option. You buy one and sell another, the two offset. Okay? So in 1 year's time, if the stock goes up, the bank pays the client $50. Pay back the money borrowed with interest. Okay, that's 86.5. And sells its position, its beta unit of shares, and get back 136.4. You add them up, it's 0. Right? Because initially, remember initially, in the last slides, initially the cost is 0. So by no arbitrage, you cannot make money from this. So no matter the stock goes up or goes down, you get 0. Right? So the bank has no risk. So just skip that second part. When the stock goes down, you add up the 3 parts, you also got 0. Okay? So again, if the bank sells the option for more than $12.4, then the bank would make a arbitrage. Right? Bank always make arbitrage because they charge a service fee. They charge a fee, right? But if they sell below $12.4, then the client can build a strategy to make a Schroding profit, a Schroding strategy, right? Then your client can arbitrage you. So the no arbitrage price is exactly 12.4. Okay. So the portfolio we constructed is called the hedging portfolio, which means if you buy an option and sell this portfolio, you will hedge out all the risk. Right? You hedge all the risk. So that's a hedging portfolio. But remember, this hedging portfolio is under our simplified framework, where we only consider 2 points in time, starting and maturity, right? Okay. So if the bank buys the option or loan or sells option or loan, then it holds some risk, market risk, okay? And then it builds this portfolio to hedge the risk. So when you put the two together, you hedge all the risk, market risk. Okay. So in practice, it's not that simple. Okay, we use more complex models, complex derivatives. We sell complex derivatives. So here we have the binomial model, which have never seen used in real life. Okay, and then later we will learn the Black-Scholes model. Right, Black-Scholes model is commonly used in the market for vanilla options because that's how they are coded. And then when you go to exotic, you may want to use some local world model, stochastic world model, or local stochastic world model, or hybrid. Okay, those are more complex models. Just for your information, no need to write it down. Okay, just for your information. More complex financial derivatives, basket options, auto-calls. That's very famous in Singapore. Maybe I introduce you a little bit of what is auto-calls. That is I think, most famous popular derivatives in Singapore to clients. Okay, it's a contract. Okay, it's an option. This option is writing on, say, 3 stocks. Okay, 3 stocks. So, okay, okay. So its initial price is 10. This is price at beginning. Okay. And then it has some notional amount, N, right? The total capital. Say it's written on $10,000 or $100,000, 1 million. Okay. So 1 month later, suppose the time is T. Okay. 1 month is TT1. Then I'll look at IS1 T1 over IS1 0. IS2 T1 over IS2 0. IS3 T1 over IS3 0. Okay, I'll look at these 3 ratios. And then I'll see, is any one of them greater than 120%? If yes, okay, you get, say, 3% of your notional. And then the contract is terminated, that's all. Okay, you get 3%, that's all. Okay, if no, if yes, and if no, you get 1% of notional, and the contract continues to next month. And every month, you ask the same question, yes or no. So you get either 3%, then stop, or you get 1%. But at maturity, say 1 year later, at maturity, you look at S1T over S10, S2T, S20. And then you're asked, any of these 3 ratios, any is less than 80%, say. Any of them. If yes, if no, it go back to here, okay? If no, you go back to ask any of them greater than 120%, you get 3%. Otherwise, you get 1%, then that's it. But if yes, so, and then let's say the minimum of this is some R. Okay? It's the minimum, okay? The smallest. Then for that the equity that give you the smallest, too bad you don't get back your notional. You don't get back your notional. You will get n over, suppose it's the second one is the smallest, okay? You'll get this amount number of shares. You'll get back shares. Which means, okay, within this 1 year, if the equities are doing okay, I'll get 1%, 1%, 1%. If it's doing very great, I get 3%, then that's it. Then I can maybe sign another contract. But that's very good. But until maturity that day, if any of them doing not good, then I'll get a big hit, right? So when you get this one, you get shares, which means you will lose at least 20%. Okay. So how do you model such complex derivatives? So this is just give you an idea what kind of exotic derivatives in the market. Okay. Banks have easier access to the market than ordinary investors, right? Some of the banks are clearing members, right? They have more resource in terms of pricing, in terms of operational, what else? Settlements, margining, right? They're more resourceful. So that's why they have lower transaction cost, and they have the ability to short. Okay. So let's come back with some definition. I think we have very seen this one. An arbitrage portfolio. What is an arbitrage portfolio? If you can build a portfolio with the first one means at the beginning, I don't need to fork out any cash. I don't need to borrow any money. I don't need to take out any money from my pocket. Initial cost is 0. And at maturity, the second one means at maturity, I won't lose any money. I will not lose any money at maturity. Okay? And the third one means not only I will not lose money, I have a positive probability that I'll make some money. Okay? These are the three three components of an arbitrage portfolio. Initially, no cost. Finally, no loss. And positive probability again. Okay? So this is a definition of an arbitrage portfolio. And we always assume the market is no arbitrage. Okay? And if you assume no arbitrage, it means that if you have two portfolios, H star and H, if your H star portfolio always gives you a better payoff than your H portfolio at maturity, then it means today the price of your H star should also be better, be higher. Okay? All right? Questions? Okay, so if you have H star greater than H, then H star, if at maturity one is greater than another, then at initial one should also be greater than another. Then simply we can arrive in the conclusion that if at maturity they are the same, at the beginning they are the same. And that's how we price the call option just now, right? We have the option, we have another strategy or a portfolio. At maturity T, they are the same. So at the beginning, they should be the same. Okay? So this is the law of one price. Okay? Sorry. And then we have this theorem that the binomial model is arbitrage-free if and only if the e to the power of rt, which is the cost of the your money market accounts, is between these two multipliers. Okay? All right. So basically, if S0, U S0, D S0. Right. So if let's construct a portfolio of S0 amount in your money market account and one share of the underlying, then your initial cost is 0, right? Your initial cost is 0. Then your maturity payoff will be this one. All right. So, because your initial cost is 0, right? Then your final payoff must be expected to be 0, right? Expected to be 0. So, oh, sorry, no. Which means your initial cost is 0 by no arbitrage. Your final payoff, VT, cannot be always positive or always negative, right? Cannot be one of them. So which means if your ERT is on one side, then both outcomes will give you positive or both outcomes will give you negative, right? Do you get the idea? So I construct such a portfolio such that my initial cost is 0. And because the initial cost of this portfolio is 0, by no arbitrage, my final payoff cannot be always positive or always negative. Otherwise, it's a portfolio, it's an arbitrage portfolio, right? And if my ERT is on one side of D or on the other side of U, then your payoff is always positive or always negative. So it's a contradiction, which means your ERT must in between D and U. Okay? You look confused. All right? Okay, maybe let's do one more step. If your ERT is smaller than D, then your VTH, right? Your ERT is smaller than U, so this is positive, right? Then your ERT is smaller than D, this is also positive, right? Okay, so okay, one is positive, one is non-negative. Then because your V0H is 0, then this is a arbitrage portfolio, right? So which means you cannot have ERT that is smaller than D. Otherwise, you will have a arbitrage portfolio. And also, similarly, your ERT cannot be greater than U. Otherwise, you will have a arbitrage portfolio. Okay? So the conclusion is ERT must in between D and U. Okay? All right. Okay. On the other side, let's consider a arbitrage portfolio. Suppose I create a portfolio which has arbitrage, okay? And I create alpha and beta such that initial cost is 0. And my alpha is minus beta at 0. So my initial cost is 0, right? My initial cost is 0 because I assume alpha is actual beta. So the final payoff of this portfolio is this one. Because my initial payoff, my initial cost is 0, right? So I should have either this one greater than 0, this one smaller than 0, or both are equal to 0, right? I should have only these two outcomes. And you know this one cannot hold, so it must be this one. Okay. So these are not like step-by-step rigorous proof. It's more like proof by contradiction. Okay. It's like the way to prove it is like I construct a portfolio, and by no arbitrage principle, I counter-proof the theorem. Okay. Okay, summary. So today we learned what is forward contracts, what is a call option, what is a put option. The first principle, how do we price a option, is by replicating portfolio. Replicating portfolio means you construct a portfolio which gives you exactly the same payoff as your option, and by no arbitrage principle, the option price today should be the your hedging portfolio or your replicating portfolio's value today. Okay? And then we have seen the first model, or the simplest model, the band monetary model. Okay? And that's then all for today. All right? After this lecture, I'll upload an exercise question in Canvas. You can take a look when you have time. Okay? I think the exercise has solutions attached. All right? Yes.
If you decide to follow group this assignment, you just email your group member's name, or we.
No, I think okay. So before the assignments, 1 week before the due date, the assignment will be uploaded in Canvas, and then within the assignment there is an instruction how 3 of you or 2 of you or alone to pick up a group in Canvas. There will be like 100 groups set up in Canvas, and you just choose one, put 3 of you, put the names in this group, and submit as this group. Yeah, the Canvas will recognize automatically.
So only one group member you can link the assignment, right?
Yeah, one group number to submit the assignment. Yes.
I want to ask to clear two. So I have kind of two intuitions that are a bit contradictory. So let's say by binomial pricing, we can see that the real world probability of price going down or
Up or down doesn't matter.
Doesn't matter to options pricing.
Yeah.
So, and what matters only is how much it goes up
Yes.
or down. So in other words, it's volatility that matters
Yes.
in options pricing.
Yes.
So options trading actually is only volatility trading instead of you having a view on the market is going up or down.
Exactly.
But it's also very intuitive and clear that if I see, say, crude oil is going to rise, I buy a
But that's your perceived trend of the market, right?
Yeah.
But it may not be true.